Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Monday, August 26th, 2024. Today's episode, I want to bring up a side-by-side comparison chart that Gareth Soloway brought up in his show today, just because I find it kind of fascinating. As he said in his show today, as much as market patterns feel like it's just crystal ball gazing, the market has a psychology. People tend to act certain ways in certain situations, and that's how we can know that certain probabilities of certain patterns play out the way they do, because everyone's looking at the same thing and they all feel the same way, and then they all do the same thing at the same time. So as much as it sometimes feels like just staring into a crystal ball and trying to see things in the stars, there is psychology behind it. What we're going to do is take a look at the same thing he brought up. This is a side-by-side comparison. The Robschild, that's the same chart, isn't it? Oh, look at this corner here, 2007. You can see it right there in the corner. This is a chart of 2007, and it is absolutely incredible what happened in 2007 to what's happened very recently. The beginning of 2007, we had, I think he said it was a 5% drop here. The same thing that just happened in April of 2024, 5% drop. Similar time frame. Look, month to month. This is March, April, May at the bottom here. So very similar time period, and the same almost an exact copy of the drop here, followed by a rally of a similar percentage. I don't remember what he said. And then in 2007, we had a collapse of something like 10%, I think he said. And this time it was 11% with a supposed yen carry trade. And then we had a major rally. And in 2007, we actually did go to a newer high briefly. And that was the peak before the great bear market and eventual crash in equities in 2008. And so, history doesn't repeat, but it sure rhymes a lot. And this parallel between what happened in 2007 and what has happened recently in markets today is absolutely fascinating. Now that the cat's out of the bag, it's like, okay, now that he shared that, now that I know that, now that you know that, now that, maybe lots more people know that, the butterfly effect, the fact that something, or the butterfly effect or Schrodinger's cat, or however you want to put it, now that that knowledge is out there and spreading, I wonder how much that's going to affect how this plays out moving forward. Will we see a new high in the S&P 500 the same way we saw in 2007 before the bear market starts, or not? Or are we going to front run the bear market because we all see it coming, or will it not even happen at all? I don't know. The other big notable thing that he said on his show that that I think everybody is kind of foreseeing here is, the first cut coming in September without inflation going down to 2%, it can mean some scary things. It can mean that the Fed is seeing things that are bad. The wording, and it's true. Gareth talked about this on his show today. What did the Fed say from Jackson Hole? They laid out basically they're going to cut in September, and it's because they don't want to see what they said is further, softening or cooling in the labor market. That's what they said. That's what they're allowed to say. They're not allowed to say that they see a huge contraction in the GDP number. By the way, the GDP number is actually the most important number. The problem is that it's so lagging. So when you have a major, we're actually going to go through GDP, talk about it a little today, but when it goes negative, especially deeply negative, that means things are absolutely falling apart, and that's when we have to have rates be slammed down and people, are losing jobs at a crazy rate. 20% of people don't have a job anymore. And that's when stuff really hits the fan. And yeah, so Gareth said that he thinks that, the amount of dovishness coming from the Fed right now is largely because that they're seeing things that we're not allowed to see, and those things are scary, and that things are probably slowing down more than anyone is pricing currently. Now, with that said, another viewpoint out there is that the Fed doesn't want major volatility in markets during elections. I don't know. I think that any way that you look at it, the fact that we're starting cuts means that, yeah, things are expected to slow down. I mean, just remember how much the Powell had been talking about how we don't want to repeat the 70s. We do not want another, uptick of inflation. We don't want to cut too quickly, too fast, so that, inflation gets out of control and people lose confidence in everything because prices are just going out of control. So I don't think they're cutting because of the election. I think they are cutting because of slowdowns that we're not seeing. I think Gareth might be right on that. Later this week, we have some important data coming out. Notably, on Wednesday, we have Nvidia coming out with their earnings after the close. If they're not making enormous amounts of money, this could actually crash markets here. Like I've been pounding the drum and screaming forever, when you have an enormous amount of speculative value already priced into the valuation of a company, especially a $3 trillion company, it's like the amount of speculative investment out there right now is massive. And if the earnings just slow down, all it takes is a slowdown of earnings for the valuation of Nvidia to normalize to some degree. I mean, who knows? Maybe they made twice as much money as expected, and it's still going to keep going up. But I don't think we'll see that. I think the amount of speculative value is so huge right now in this company that it's pretty inevitable that we're going to be going the other way. PE ratio of 70. Again, it has to have like an enormously larger amount of earnings than probably what's even supposedly expected in order for its valuation to even just stay flat here. I'm expecting a collapse here. Potentially Thursday, actually. Potentially because of this Nvidia earnings, if I really look into my crystal ball here. Thursday, also, we have Q2 GDP second revision, and I want to talk about that a little bit. Last was a 2.8% increase of GDP. If this ever goes negative, that's like really bad, like I was saying at the beginning of the show. So we have our second revision coming out on Thursday, followed by Friday PCE data. One thing I wanted to bring up, I found an article from the Federal Reserve Bank, St. Louis. This is from 2014. Do revisions to GDP follow patterns? Now, here are the revisions from preliminary to the final. And so we have our second revision. I think after the second revision we get the final one later. And the quote I want to take from this article is right here. While there are no obvious patterns, there are typically large negative revisions from preliminary releases to the final releases at the beginning of recessions. So admittedly, it can go way up, it can go way down as far as the revision goes. Remember, this is like, they were on the first onset, they say, let's say a 2% GDP, and then like the next revision 2.1, and then the next one 2.2. Well, that would be a positive 0.2 revision on this chart. That's how this would be labeled. So this is just marking the amount of revision. And what he's noting here is that there are large spikes downward in the revisions at the beginning of most recessions. Here in 1989, looks like it was before the recession. And so while you can see negative revisions without recessions, it's just another indicator that you can add to your list of things that can predict recessions. So if this one comes out on Thursday, less than 2.8% as it was before, or especially if it's significantly lower than 2.8%, that could add to the fire that's already burning. Before we go through the rest of the charts, I wanted to note next week we have job openings. Could be, it's a big part of the beverage curve. The last reading of this was 8.18 million. Are job openings drying up? Are they increasing? Are they staying the same? That could be fairly eventful. And then the huge one is, and my favorite one, the most important leading indicator in my book, is the unemployment rate. This is the number that triggered the Sound rule the last time this came out at 4.3%. So it will be extremely interesting to see if this ticks up higher or, ticks down a little bit, or who knows, maybe it'll collapse here and we actually are headed towards a soft landing. I have my extreme doubts. Daily reminder, 2-year, 10-year Treasury yield curve is still inverted. 2 years and counting. I think it's about 2 years and a month and a half right now, and the Sound rule was triggered last month, suggesting that the recession has indeed already started. S&P 500 still following. I'm going to leave this drawing on here. It still looks like this may play out the way that I fully expect it to. Head and shoulders top here. Looking at that parallel to the 2007 chart makes me think, okay, well, yeah, I mean, it would be funny, like, if that did play out like an exact replica of 2007. We get a new high and that's it. If we do get to new highs, I mean, I'm going to be adding more and more to short positions here, because it's just too obvious to me. The S&P 500, the PE ratio of the whole thing right now, being hovering around almost 30, everything overvalued. We're cutting, Sound rule triggered, unemployment's going up. It's like, this is it. We finally made it. The yield curve being inverted this long, I mean, the yield curve never inverts this long. This is like Great Depression kind of stuff. But, with the market at all-time highs, great opportunity to short, in my opinion. Again, never any advice on this show. NASDAQ 100, triple Qs, same thing. It looks like we are rolling over here from, it just looks like it. So I'm thinking we don't get that secondary high. I think this is it. I think this is the top here. But I've been wrong before. I've been calling tops this whole time just because of how things are overvalued, and with the yield curve inversion, it's like eventually this should at least normalize. And by normalize, I mean drop in price by 30% from here. And usually when you get a move like that, dropping 30%, it usually goes way further than it even should. Obviously a very similar pattern in SMH. This is the semiconductors. Huge portion of this is Nvidia itself, with its earnings coming out Wednesday. My guess is we go sideways. It's Monday. It's already so we have tomorrow one more candle, and then Wednesday we'll have a candle for that, and then after the market closes, so Thursday, this should be absolutely collapsing here in my estimation. The VIX smells a ton of fear here, still inverted from October through the January contract on the VIX futures term structure. People are buying protection including myself, I think this is it. I think we're going down from here. Treasury bonds, TLT. If you've been watching my show, you know I'm highly exposed to this. We've been having an ascending channel here. Typically, the typical thing to do with an ascending channel is to break to the downside. On a daily time frame, I'm not bullish or bearish on this, but if things play out the way I expect them to and we have a collapse in equity markets, this should at least temporarily spike massively. You know, in the crash of 2007-2008, TLT itself went up about 40%, I think, in value before going straight back down. So that's the event I'm sort of waiting for here and fully expecting to happen. Again, no investment advice. I'm just a guy with a crystal ball. Always remember that. Interestingly, as much as TLT looks like it may be even breaking out of this to the downside, if you take a look at like the 10-year yield, we're still within this range. The 30-year yield as well. We're not breaking out of any patterns, and so I think maybe the NAV, maybe people, I don't know what happened here with TLT, if this counts as a break or not. Honestly, I'm not like a super strong expert in terms of reading charts, by the way. I know how to see basic, obvious things that are going on. That's kind of what I'm here for. HYG, high yield corporate, junk bonds, just at a relatively very high price to the very recent past. I'm blown away at how tight credit spreads are right now. Benjamin Graham says never buy junk bonds at par. He says that basically explicitly. He doesn't use those words, but that's basically what he says. And when credit spreads are like so incredibly tight, it's basically what people are doing. They're paying full price or near full price for junk bonds, which when the stuff hits the fan, a good portion of these will lose all of their value, which is why you're supposed to have a certain amount of credit spread. Right now, people are willing to take a lot of risk here for the amount of yield that they're getting in junk bonds. Mr. Markets has lost its mind. It's about to get into greedy mode here in the fear and greed index. We've been creeping up and up and up in the neutral. Yeah, we'll see if he gets greedy here. I don't know. Last chart I wanted to bring up was oil. Oil ticked up today. I believe it was from some kind of Middle Eastern conflict, a little bit of an oil shock kind of a thing, but nothing major here. We're still trending lower, it seems. And where I am here in Florida, driving around, gas prices have suddenly plummeted. I don't know if anyone else is experiencing that out there, but I just wanted to make note of that, I guess. That's all from me in my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.